They didn't trade the same way. They didn't even believe in the same theories. But every great investor followed one forgotten rule, the same law that quietly built every fortune in history. Today, we'll break down 4 timeless rules that turned ordinary investors into legends, and why most people keep ignoring them. Rule number 1, never lose money. Rule number 2, never forget rule number 1. Buffett lives by one rule, the rule most investors forget the moment fear takes over. In 2008, while the world was falling apart, Warren Buffett was buying Coca-Cola, American Express, Wells Fargo. When everyone was screaming crash, he was quietly doing math. Buffett's rule isn't about avoiding red days or small drawdowns. It's about avoiding permanent loss, the kind you never recover from. You see, if you lose 50% of your capital, you need a 100% gain just to get back to even. That's not just math. That's time you'll never get back. The greatest investors don't build wealth by chasing every rally. They build it by surviving every crash, because compounding only works if you're still in the game. That's why Buffett treats capital like oxygen. You don't notice it until it's gone. Most investors break this rule because it feels boring. They confuse movement with progress. But in markets, excitement is usually expensive. Protecting capital isn't a defensive strategy, it's an offensive one. Because the investor who never blows up eventually wins by default. Stanley Druckenmiller, on the other hand, was faithful to another principle that established his career, and it was as follows. The best investors have the courage to bet big when they know they're right. Most investors spread their bets so thin that even when they're right, it doesn't matter. But legends like Stan Druckenmiller built fortunes by doing the opposite, betting big, but only when everything lined up. In 1992, Druckenmiller and George Soros saw something no one else dared to believe, that the British pound couldn't survive inside the European exchange rate mechanism. They didn't hedge their view, they pressed it. In one night, they shorted over $10 billion worth of pounds and won over $1 billion. It wasn't luck. Druckenmiller spent months studying the data policy pressure, interest differentials, capital flows. He waited for alignment when fundamentals, timing, and liquidity pointed in the same direction. That's when he struck, not before, not after. Most people make the same mistake. They bet small all the time, instead of big at the right time. Great investors do the opposite. They wait, and then they press, when the odds are stacked in their favor. Conviction doesn't mean confidence. It means discipline, knowing the difference between a strong thesis and a perfect storm. Druckenmiller didn't bet big often, but when he did, he made sure being wrong wouldn't destroy him. It's not about being bold every day. It's about waiting for the one moment when everything aligns and having the courage to act decisively when it finally does. Let's move on to another legendary investor, Peter Lynch, and his rule. Know what you own and know why you own it. Most investors can tell you the ticker they own, but not the business behind it. They trade symbols, not companies. Peter Lynch called that the biggest mistake in investing. Lynch wasn't hunting secret hedge fund data or algorithmic edges. He just looked around. When he saw a line outside Dunkin' Donuts every morning, he didn't complain about inflation. He bought the company. His rule was simple: invest in what you understand. If you can explain how a business makes money without using buzzwords, you already have an advantage over half of Wall Street. Understanding turns noise into signal. When the stock drops 10%, you know if it's fear or something real. That's what keeps you in when others panic. Knowledge isn't about predicting price, it's about conviction. When you know what you own, volatility becomes opportunity, not fear. Peter Lynch turned common sense into billions because while others chased trends, he just paid attention to what he owns and why he owns it. Let's end this episode with quotes from two more investing legends, Howard Marks and George Soros. Being early is the same as being wrong, until it isn't. Additionally, the first law of capitalism, when something is too good to be true, it usually is. Every bubble feels rational while it's growing because it rewards you until it punishes everyone at once. In 1999, George Soros's fund was riding the tech boom. Stocks were doubling every few weeks, but Soros saw the signs. Valuations disconnected from reality. Analysts speaking in dreams. He pulled billions out, months before the crash. Smart investors don't try to sell at the top. They sell when logic stops making sense, and when fear disappears completely, because that's when risk hides in plain sight. Howard Marks wrote in 2007, "We're dancing on a volcano." A few months later, Lehman collapsed. Being early looked wrong until it was right. You don't need to time the exact top. You just need to recognize when the story stops making financial sense and have the discipline to walk away, because surviving the crash gives you the chance to buy when the real opportunity appears. The legends didn't get rich by being fearless. They got rich by knowing when the party was over and leaving before the lights went out. Markets change, technologies evolve, but human behavior, fear, greed, denial, always stays the same. And that's why these rules still work. Protect first, be bold, but rarely. Understand what you own, and when the story stops making sense, walk away. If you remember even one of these rules, you'll already be ahead of 90% of investors. This is X-Ray Finance, where we don't predict, we understand.